Good morning. Hope you have tried these objective type questions on your own and coming back to the solution video. Let us begin. Marginal cost of the product is its variable cost. Yeah, we had seen in the introduction lecture itself, marginal costing is nothing but variable cost. Marginal cost is equal to variable cost. Marginal cost is equal to prime cost. Is it so? False. First one is true, second one is false. Why? Marginal cost is equal to prime cost plus all variable expenses. Prime cost is a variable cost plus all variable expenses. Then, when output increases, marginal cost per unit also increases. Is it true? Is it whether marginal cost per unit will increase? No. Variable cost per unit remains what? Constant. Marginal costing is also known as direct costing. True. We charge only variable cost for inventory valuation and other things. Okay, it is also known as direct cost. In marginal costing, fixed costs are treated as product cost. Is it treated as product cost? No, false. It is a period cost. It is charged in P&L account. Okay, false. Marginal costing is a method of cost ascertainment. Is it a method of cost ascertainment? It's a technique of cost ascertainment. 1.6 is false. 1.7. Marginal costing cannot be used in a company where the process costing is being used. Okay, is it so? Marginal costing can be applied in any industry. Marginal costing can be applied in any industry. False. Marginal costing, work in progress are valued at variable cost. True. Okay, marginal costing, work in progress is valued at variable cost. Is it true? Yes, because we ignore fixed cost for decision making and product valuation. Marginal costing can be used along with standard costing. Standard costing is nothing but predetermining the cost. We are going to see in standard costing and variance analysis or budgetary control where predetermined cost can be used along with marginal cost. In marginal costing, fixed costs are excluded in inventory valuation. Fixed costs is excluded in inventory valuation. True. Fixed cost is equal to contribution minus variable cost. No. Contribution minus variable cost, there is no such formula. Fixed cost is nothing but contribution minus profit. False. Fixed cost is equal to, fixed cost minus loss is equal to sales minus contribution. Yes. Sales minus contribution will give us variable cost. Sales minus contribution will give us variable cost. But it is given as fixed cost minus loss as sales minus contribution. False. Contribution plus variable cost is equal to selling price. True. We know selling price is equal to variable cost plus contribution, or we can say contribution is equal to selling price minus variable cost. Contribution is equal to selling price minus variable cost. So when you interchange, okay, contribution plus variable cost is equal to selling price. Profit is equal to contribution minus fixed cost. True. We had seen in marginal costing statement, income statement, first class itself, contribution minus fixed cost gives you profit. Valuation of stock is higher in marginal costing than absorption costing. Is it true? In marginal costing, we include only variable cost. In absorption costing, we include both fixed as well as variable cost. It is false. Go to that. When there is opening and closing stock of WIP and finished goods, there may be a difference. Yeah, we had seen, the last session only we had seen. When there is a difference in stock, there will be a difference in profit between marginal costing and absorption costing. True. Then 1.17. In marginal costing, managerial decisions are guided by contribution margin than by profit. Yes, we had seen in the first class, okay, if contribution is positive, the product should be continued. Or even in last class, we had seen make or buy decisions, further process decisions, all those things. Okay, when contribution is positive, we continue with the product. When contribution is positive, we continue with the product. Semi-variable cost and marginal costing form part of product cost. Yes, let it be variable cost or semi-variable cost, it is forming part of production cost. True. Marginal costing cannot be applied in building business. Yes, where you find more fixed costs are involved or more job oriented costs are involved, it cannot be applied. Contribution amount cannot be shown in or known in break-even point. Contribution yeah, we can show when you draw a sales line, when you draw a variable cost line, the difference is contribution. Okay, sales variable cost line, when you draw, you can find out what? Contribution margin. Break-even point can be studied in profit volume chart. Yes, we had seen break-even chart. Okay, so where we can study the profit volume when fixed cost and variable cost, total cost and total revenue intersect, that is called as break-even point. Okay, beyond the break-even point it is profit zone, below that it is a loss zone. High PV ratio indicates decrease in volume will result in increase in profit. False. How decrease in volume will increase the profit? False. A high margin of safety shows actual sales is much higher than break-even sales. True. Because when you have high margin of safety, your actual sales is more. Margin of safety cannot be improved by lowering fixed cost. False. When you lower the fixed cost, break-even point will come down. So actual sales minus break-even point will give us more margin of safety. It is false. It can be improved. That's why it is false. Increase in selling price will have no increase in margin of safety. False. If you increase the selling price, more sales, more profit, more margin of safety. Margin of safety is equal to into profit volume ratio is equal to profit. True. We know profit by PV ratio gives us margin of safety. Therefore, margin of safety into PV ratio will give us what? Profit. Under marginal costing, direct contribution directly varies with sales. Yes. More sales, more contribution. True. Net profit under marginal costing and absorption costing is the same. Is it the same? It will change. It will change. When it will change? When there is a difference in stock, it will change. You cannot say it is always the same or same. Blind statement you cannot make. False. At break-even point, yeah, contribution will be equal to fixed cost. That's why profit or loss becomes zero. True. Contribution is equal to fixed cost. Marginal costing is a technique of controlling the cost. No, it is a technique of ascertaining the cost. It is not a technique to control the cost. It is false. Break-even point analysis is based on the assumption that variable cost directly varies with volume of output. True. Okay. Break-even point is based on fixed cost remains constant. Variable cost directly changes with output. Margin of safety shows excess of actual sales over budgeted sales. No. Margin of safety is nothing but actual sales minus break-even point. False. PV ratio indicates the relationship between profit and sales. No. It is a relationship between contribution and sales. False. Differential or cost analysis can be made in case of both absorption costing as well as marginal costing. No. Differential cost analysis means what cost changes with output, what cost is remaining constant, like that. We make such analysis only in marginal costing, not in absorption costing. False. When PV ratio is 50%, margin of safety is 40%. 50 into 40% will give us 20%. 50 into 40% will give us 20%. True. 1.35 true. All direct costs are variable and all indirect costs are fixed. It need not be. Direct cost like manager's salary can be a fixed cost. Okay. Direct costs associated with the production can be a fixed cost. Indirect cost like consumable stores can be variable also. It is false. Marginal costing does away with under and over absorption of fixed overheads. True. Because we don't consider fixed overheads at all. We don't absorb or we don't charge fixed overheads at all. So in marginal costing, we don't mind about a variable cost and which one? Fixed. We don't mind about fixed cost. Yes, true. PV chart represents, yes, cost, volume, profit relationship. Okay. In the horizontal line, we put volume. In the vertical line, we put which one? Profit, sales, cost. Yeah, it's cost, volume, profit relationship. True. Angle of incidence is found by intersection of sales line and total cost line. False. It is given as sales and which line? Variable cost line. It is false. Marginal costing, fixed costs are apportioned on arbitrary basis. False. In marginal costing, we don't apportion fixed cost at all. Only variable cost is considered. Fixed cost is just taken for calculating profit or loss. We don't apportion at all. False. A rise in fixed cost will not affect the PV ratio. Yes. PV ratio is affected only because of sales and variable cost and not because of fixed cost. True. True. Next. Other things being equal, decrease in variable cost will decrease the PV ratio. See, when variable cost decreases, sales minus variable cost, you will have more contribution. You will have more contribution. It will increase the PV ratio. It will increase the PV ratio. True. When closing stock is more than the opening stock. When closing stock is more than the opening stock, profit in marginal costing will be more than absorption costing. In closing stock is more than the opening stock. That is, production is more than the sales. Profit in which method will be more? We had seen just in the last class. Absorption costing will be more because the value of closing stock will be more in absorption costing. If you are crediting more, the profit will be more. Okay, so it is false. Profit in absorption costing will be more than the marginal costing when closing stock is more than the opening stock. PV ratio can be improved by increasing the selling price. True. When selling price is more, automatically contribution will be more, PV ratio will be more. Break-even point is on the assumption that sales is more than the production. Whether we make such assumptions? No. It is based on fixed cost, PV ratio, fixed cost, contribution per unit. Okay. We don't assume anything in calculating the break-even point like this. False. Profit is not affected by the amount of change in fixed cost. Contribution minus fixed cost, we work out profit. Whether profit is not affected or affected. Profit is affected by the amount of change in fixed cost. False. In break-even point, one can study profit or loss at various levels of activity. No, for that you have to prepare a budget. In break-even point, you can find out only the profit zone, loss zone. False. A low PV ratio indicates low profitability. How it can be high profitability? False. When fixed cost is 12,000, PV ratio is 25%, break-even point is 48,000 units. Try this. If you have not tried it. Fixed cost by PV ratio gives us break-even point. So 12,000 by 25%. How much? 12,000 by 25%. 12,000 divided by 25% will give us, you can do it in calculator, 48,000. So answer is true. 12,000 by 25%, 48,000. Answer is true. Like that you will tick a wrong answer. Remember, fixed cost by PV ratio will give you value in rupees. Fixed cost by PV ratio will give us break-even point in rupees. But look at what they have given. Fixed cost divided by break-even point, they have given 48,000 units. They have given 48,000 units, which is wrong. It should be 48,000 rupees, not units. So it is a false statement. It is a false statement. Fixed cost by PV ratio gives us value. False. So it is false. Right? So it should be 48,000 rupees. Okay, next. When break-even point is 30,000, contribution is 20,000, profit is 10,000. See, at break-even point, how profit will come? How profit will come in break-even point? There will be no profit and no loss. So false. 1.50 also false. This is also false. Next. Marginal costing is based on the classification of cost into. How do we classify the cost in marginal costing? How do we classify the cost in marginal costing? Fixed cost and variable cost. Fixed cost and variable cost. Dash is the difference between sales and variable cost. Contribution, right? In marginal costing, stock of finished goods is valued at variable cost. Stock of finished goods is valued at variable cost. When marginal costing is used, only variable cost can be charged to products. In marginal costing only, variable cost is charged to product. If there is no production, sales is 0, variable cost will be 0, loss will be equal to fixed cost. Loss will be equal to fixed cost. The difference between actual sales and break-even point is known as margin of safety. Margin of safety. The PV ratio shows the relationship between contribution and sales. Contribution and sales. Relationship between contribution and sales. I request you to note down the answer. I already instructed in the first lecture itself. Please note down the answer only in your notebook, not in the material. When key factor is operation, we had seen key factor, how we rank the product based on contribution per unit of key factor. So best position is reached when contribution per unit of key factor is maximum. Contribution per unit of key factor is maximum. Under dash costing, a company can affect the profit by controlling the volume of production. Marginal costing. Marginal costing. Dash costing assigns only prime cost and variable overheads to product cost. Marginal costing. Marginal cost is equal to prime cost plus variable overheads. Direct costing is also known as marginal costing. We make a difference between fixed cost and variable cost. Okay, point number 10 or question number 10, marginal costing. This one is variable cost and fixed cost. Variable cost and fixed cost. Contribution will be dash than profits after break-even sales. Below the break-even sales, loss. After the break-even, beyond the break-even sales, contribution will be more than the fixed cost. Contribution will be more than the fixed cost. Only then you will get the profit. Contribution will be more than the profits. In marginal costing, fixed costs are charged to products. Fixed costs are charged to P&L account. Fixed costs are charged to P&L account. At break-even point, total cost is equal to total revenue. Break-even point, total cost is equal to total revenue, or we can say contribution is equal to fixed cost. Total cost is equal to total revenue. Next question you can answer. In profit volume chart, horizontal axis represents volume of output or sales. Vertical axis represents cost or revenue. Okay, horizontal axis volume of output, vertical axis sales, cost and revenue. When fixed cost is 10,000, contribution is 5. 10,000 by 5. 10,000 by 5 will give us break-even point. 10,000 divided by 5, 2,000 units. Break-even point is 500, contribution is 23. So 500 into 23. 500 into 23. I hope it will be 11,200. Okay, that will be equal to fixed cost. So whatever you get as 500 into 23, 11,500 is equal to fixed cost. Contribution is equal to fixed cost when there is a break-even point. Margin of safety can be improved by increasing the volume of sales. This we had seen. At break-even point, contribution is equal to fixed cost. Intersection of which lines makes the break-even point? Total cost and total revenue lines. Profit volume chart is the pictorial representation of cost volume profit relationship. If selling price goes up, you will have more contribution, more PV ratio. When there is more contribution, more PV ratio, break-even point can be lowered or reduced. Break-even point can be lowered or reduced. Because when there is higher contribution, you can achieve break-even point with the lower volume. Clear? Break-even point can be reduced when selling price is increased. Break-even point increases when fixed cost increases. When fixed cost increases, you have to cover up more fixed cost, so more sales will be required. So when fixed cost goes up, okay, break-even point will increase. When production is less than the profit, when production is less than the sales. When production is less than the sales, which means you sold the opening stock also. When production is less than the sales, profit in marginal costing will be dash than absorption costing. Can you answer this? It will be more closing stock. When production is less than the sales, okay, profit in marginal costing will be more than absorption costing, or you can say profit in absorption costing will be less than marginal costing, because you will have lesser closing stock, more opening stock. When sales is more, you will have lesser closing stock, more opening stock. So profit in marginal costing will be more than absorption costing. Other method of telling, profit in absorption costing will be less than profit in marginal costing. So here it is more than that of absorption costing. X-axis represents, horizontal axis represents volume of output. X-axis means horizontal axis, volume of output or volume of sales. Y-axis represents revenue, cost and profit. Revenue, cost and profit, or you can say revenue and cost. Formula for calculating break-even point: fixed cost by PV ratio. Fixed cost by PV ratio. This one you can answer. 10,000 divided by 2, 5,000 units. 10,000 divided by 2, 5,000 units. When fixed cost is 25,000, PV ratio is 25%. 25,000 divided by 25%, it will be 1 lakh. 1 lakh. PV ratio is 30%, margin of safety is 40%, means profit will be 12%. 30 into 40%, 12%. Okay, in break-even graph, break-even sales takes place at when total cost line and total sales line intersect each other. Ignore this question, it is a wrong question. It is a wrong question. Increase in fixed cost will increase the break-even point. Decrease in variable cost will result in more contribution. Decrease in variable cost will result in more contribution. So it will lower the break-even point. Higher the contribution, fixed cost by contribution per unit, fixed cost divided by contribution per unit, it will lower the break-even point or reduce the break-even point. If variable cost is 70%, we know the remaining 30% is PV ratio. See, the CVP analysis will be most helpful for preparing flexible budgets. We are going to see in the next chapter preparation of budgets, where we will be using the fixed cost and variable cost separation. Okay, so at the time it will be helpful in preparation of flexible budgets. As long as your revenue is more than the cost, you can increase the output. Marginal revenue is more than the marginal cost, you can increase the output. In marginal costing, the profitability is indicated by which one? Contribution margin. Please ignore this. Please ignore question number 39 and 40. They are wrongly constructed questions. When absorption costing is used, profit is more than the marginal costing when production exceeds sales. When production is more than the sales, you will have more closing stock than the opening stock. So uh, production exceeds sales. Fixed cost 40,000, contribution 8. So 40,000 into 8, 5,000 units will be the break-even point. 40,000 divided by 8. When contribution is, when break-even point is 1,000, contribution is 5. So 10,000 into 5, 5,000. 1,000 into 5, 5,000. A factor is an activity of an undertaking which is in short supply. Any factor which is in short supply, we had seen, it is called as key factor or limiting factor. Key factor or limiting factor. Break-even point is rupees 3,000. Margin of safety is 50,000. Then actual sales must be 53,000. Right? Actual sales minus break-even point will give us margin of safety. So 3,000 is break-even point. Margin of safety is 50,000. So actual sales must be 53,000. Marginal costing means which one? Prime cost plus variable overheads. Prime cost plus variable overhead is called as what? Marginal cost. One of the differences between marginal costing and absorbed costing is the treatment of which overheads. Direct material we include in both. Variable overheads we include in both. Prime cost we include in both. Fixed overheads. Because fixed overheads are not considered in marginal costing, it is considered in absorption costing. Contribution margin is also known as marginal income. Contribution margin is also known as marginal income. When you increase the output, the incremental income, sales minus cost, variable cost, marginal income. Period cost, otherwise called as the costs which are charged in P&L account. Fixed costs are charged in P&L account. Product costs are those variable costs. Period costs means the costs that are charged in P&L account, fixed cost. A costing method where the fixed overheads are added in inventory valuation, which means fixed overheads are included in inventory valuation. Option is not there. Make an option, option D. Option D, absorption costing. Option D, that is not typed. Absorption costing, where we include factory overheads, fixed overheads also. Absorption costing. Not direct costing, marginal costing, prime cost. It is D. Added absorption costing. Profit shown by absorption costing will tend to increase by marginal costing. That is, profit in absorption costing is more than marginal costing when production is more than sales. When production is more than sales. There will be no difference between marginal costing and absorption costing. Profit will be there when they are equal. When opening stock and closing stocks are equal. We had seen in the last class, when opening stock and closing stock of finished goods are same, profit under both the methods will be same. Go to that. Absorption costing differs from marginal costing in the amount of cost assigned to the individual units of products. Because in absorption costing we include both variable cost and fixed cost. In marginal costing we include only variable cost. Reporting under marginal costing is accomplished by this is not the answer. Okay, reporting under marginal costing, sales minus variable cost contribution. Contribution minus fixed cost will give us what? Profit. C is the answer. Matching variable cost against revenue and treating fixed cost as what? Period cost fully charged against contribution. C is the answer. Under marginal costing concept, unit product cost will be increased. See, marginal cost means variable cost. When variable cost will change? Not because of change in number of units. Yeah, increase in commission. Commission paid to salesman is a variable expense. Okay, when you pay more commission, more variable cost per unit will come, marginal cost will go up. Marginal cost will go up. See, when the output changes, only total variable cost will change. Per unit variable cost will change only when there is a more commission paid. Depreciation, there is a fixed cost. There is a fixed cost. Okay. So contribution is equal to sales minus variable cost, option is not there, or fixed cost plus profit. Fixed cost plus profit, that option is also not there. We worked out contribution is equal to sales minus variable cost or fixed cost plus profit. Here there is a loss. Yeah, fixed cost minus loss also will give us contribution. Answer is C. Fixed cost minus loss also will give us contribution. PV ratio is the indicator of profitability. It is the indicator of profitability. Fixed cost is 10,000, PV ratio is 50% means ignore this additional thing. 10,000 by 50%, 20,000 is the answer. 20,000 is the answer. Fixed cost 7,000, profit is 3,000, sales is 50,000, PV ratio. How to work out? Contribution by sales. Contribution is nothing but fixed cost plus profit. 7,000 plus 3,000, 10,000. 10,000 is contribution divided by sales, 50,000 into 100, 20%. 7,000 plus 3,000, 10,000 is contribution divided by sales, 50,000 into 100 will give us 20%. This is a wrong question. It's a wrong question, please eliminate. If net profit is 10%, PV ratio is 50%. If net profit is 10%, PV ratio is 50%. Profit by PV ratio, 10 by 50%. 10 by 50% will give us 20%. Margin of safety is nothing but profit by PV ratio. 10 by 50% will give us 20%. Margin of safety can be improved by increasing the sales volume, increasing the selling price, lowering the fixed cost, lowering the variable cost, lowering the fixed cost, all of these. Clear? Increasing the sales volume, more sales. Increasing the selling price also, more revenue. Lowering the variable cost also, more contribution. Lowering the fixed cost also will reduce the break-even point. So, all of these is the answer. An item of cost which is entirely differential, we call it as which cost? Direct cost. Anything that changes directly with output, we call it as which one? Direct cost. 1.19, read through that. They want to increase the car production. The sales manager reported total additional cost required for increase in the level of production. When there is a change in the level of production from 4,000 units to 5,000 units, 40,000 units to 80,000 units, like that, when you report the total change, that is called as differential cost. That is called as what? Differential cost. When you change the capacity, okay, due to change in capacity, whatever the cost arises, we call it as which one? Differential cost. Go to the next one. Unused production capacity. The idle plant facility can be used for lower margin item. The lower margin item should be produced if it can be sold more than the variable cost. Always, when you can sell the product more than the variable cost, you can produce. CVP analysis is the most important thing to determine. First answer. Yeah. What is the main objective of cost volume profit analysis? To determine break-even point. The alternative which will increase the contribution margin, which will be most 20%, is increasing the selling price. Increasing the selling price will have more effect than lowering the variable cost. Increasing the selling price. When referred to margin of safety, one has to keep it in mind. What do you mean by margin of safety? Actual sales minus break-even sales. Answer is B. Actual sales minus break-even sales. Okay. Next. Conventional break-even point does not assume that Variable cost will vary. Selling price will remain fixed. Total cost will remain the same. This assumption is not there. Does not assume. All the assumptions are not there. This assumption is not there. Productivity per worker, that is not discussed in marginal costing. If fixed cost decreases while variable cost remains constant, fixed cost decreases, fixed cost is reduced, which means fixed cost by contribution per unit. When fixed cost is reduced, we require lower volume to get that break-even point. Break-even point will become, it will get reduced. If fixed cost decrease with variable cost remains constant, new contribution margin, see, contribution margin will change only when there is a change in sales or variable cost and not because of any other thing. Okay, unchanged, it remains unchanged. Contribution is not affected because of fixed cost. When margin of safety is 20%, contribution ratio is 60%, 20 into 60%, 12%. 20 into 60%. Margin of safety into PV ratio will give us profit. When fixed cost is 20,000, margin of safety is 20%, 10,000. PV ratio cannot be computed. We want more details. Okay, we want sales or variable cost or at least contribution, something we need to find. The information is not sufficient. When sales jumped from 3 lakh to 4 lakh, profit increased by 40,000. So PV ratios, change in profit by change in sales into 100, that we had seen in the last part, in the last lecture. So change in sales by, change in profit by change in sales. 40,000 divided by 1 lakh into 100, 40%. Answer is 40%. When total fixed cost is 50,000, variable cost is 75%. Sorry, there is a mistake here. There's a mistake here. It is 75%. Variable cost is 75%. Break-even point will be 50,000 divided by 25%. Because when variable cost is 75%, there is a typing error. When variable cost is 75%, remaining 25% will be which one? PV ratio, contribution, right? So 50,000 divided by 25% will give us 2 lakhs. 50,000 divided by 25% will give us 2 lakhs. Of the sales 2 lakhs, fixed cost is 30,000, PV ratios 40%. What is the net profit? Simple. Sales into PV ratio 40% will give us sales 2 lakhs, PV ratio 40%. What is PV ratio? Contribution ratio. So 2 lakhs into 40% will give us 80,000. 80,000 minus fixed cost 30,000 will give us profit. Once again I repeat, 2 lakhs into 40%, 80,000. 80,000 minus 30,000, 50,000 is going to be the profit. In a profit graph, ignore all these things. Ignore all these things. In break-even chart, y-axis represents, vertical axis represents sales volume or output. Sales volume or output. When you want to have a contribution in the break-even chart, okay, you should draw variable cost line, then you should draw sales line. When you draw variable cost line and sales line, you can find out. Answer is A. Answer is A. When sales is 80,000, PV ratio is 80%, variable cost will be 20%. When PV ratio is 80%, variable cost will be 20% of 80,000, 16,000. 80,000 into 20%, 16,000. This we know, fixed cost plus profit by PV ratio. 10,000 plus 20,000, 30,000 by 20%, 1,50,000. 30,000 by 20%, 1,50,000. When firms use marginal costing, product cost includes variable overheads. Product cost includes variable overheads. That is a correct option, most correct option. When sales volume increases, BEP will not be changing. BEP changes because of fixed cost, selling price, variable cost. When sales volume increases, number of units sold increases, total profit will increase. Total profit will increase. Which of the following will have an increase in contribution per margin per unit? When you increase the selling price, it will have a higher impact than reducing the variable cost. We had seen this as a concept question, right? So you can refer the last video also once more, the change in fixed cost, variable cost, PV ratio, all those things, okay? 20% increase in selling price will have a more impact than 20% decrease in variable cost. If you want, I'll explain. Let us take current selling price as 100 and variable cost as 60. Okay, your contribution is 40. Contribution is 40. Now, you want to lower the variable cost by 20%, which means 100, this will be 60 minus 20%. 60 minus 20% is, example I am just using, 12 rupees, okay, 48. So this will be 52 rupees. If you lower variable cost by 20%. If you increase selling price by 20%, this will become 100 plus 20, 120. 100 plus 120, 120. Variable cost we keep the same, 60. In this option, I lowered the variable cost by 20%. Reduce the variable cost by 20%. Here, increase the selling price by 20%. So what will be the contribution? 60. So which will have a better impact? Increasing the selling price will have a better impact. So that is a correct option. Go to the next one. 1.42. Idle capacity is available. 20,000 sneakers at 6.6 per pair. Normal selling price, please ignore. Variable cost of manufacturing is 1.5. It will not incur any selling expenses. What will be the effect of net income if the special order is accepted without affecting the normal sales? Simple. When you accept the offer, your sales will be 6 rupees, variable cost will be 1.5. Okay, what is the special offer's selling price? 6. What is going to be the variable cost? 1.5. 6 minus 1.5, 4.5 per unit you will get as a contribution. So 20,000 into 4.5, 90,000 you will get additional income. Otherwise, sales 20,000 into 6, variable cost 20,000 into 1.5, do it, you will get 90,000 rupees contribution. Okay, it is idle capacity used, so it will not increase your fixed cost. Okay, x-axis represents volume of sales in units. Volume of sales in units, horizontal axis, which is not the assumption of break-even analysis. Yeah, all goods produced or sold is the assumption. All goods produced or sold is the assumption. It is given as are not sold. So that is the mistake here. So which is not, C is not the assumption. Then PV ratio of a company can be improved by increasing the selling price, increasing the variable cost. No, increasing fixed cost will not affect your PV ratio. It is increasing the selling price. It is increasing the selling price. So when selling price is more, you will get more contribution, more PV ratio will come. So with this discussion of marginal costing is over. What next? You have to take up a test. I'll pose the test questions. I'll pose the test question appending to this. Okay. Next class. Okay. It will be appending to this. Question will be posted. A test question will be posted. I request you to take up the test. First. See your answer. Then open the next video. Okay, the next lecture will have the solution to test questions. So without taking up the test, I request you not to go to the next lecture or next video. Please take up the text next. That is, the material is shared in the PDF form in the group itself. Please write the test and the solution you can go to it after that. So with that, marginal costing will be over. After marginal costing, we will be taking up a chapter called either a cash flow statement or budgetary control we will move. Okay. So, complete learning marginal costing, of course, including this, update your notes, revise, take up the next test that is posted immediately. Okay, that is there in the end of the lecture. Okay, separately as a PDF thing in the drive. Okay, please take up the test, then open the next video. Okay, wishing you the best, all the best. Have a great day.